corporate loans. Now there is a good asset mix. Sorry, is there some reminder being given anyway? Sanctioning and monitoring of big loans strictly separated so that there are no confusion between the authorities. And then quality of tier 1 capital also has been enhanced. Very importantly, stressed asset verticals are already created, as opposed to the inadequate slippage prevention mechanism, which really let us down in the previous years. Going over quickly again, Fugitive Economic Offenders Act has been passed, as a result of which many of those fugitives and their assets have been, at least their assets have been confiscated, and having confiscated their assets, we are after them wherever they are to get them back into this country to face the law of the land. Then PSP loans, which is within 59 minutes, you're very aware, now we are bringing in a lot more energy into that, so most of the loans sooner will be going through in-principle approval in this manner and then getting followed up further. Then foreign branches are rationalized. Adherence to risk-based pricing is also happening as opposed to the ad hoc pricing system, pricing mechanism which existed earlier. Then retail and MSME LMS are also implemented. LMS meaning loan management systems are implemented. Quickly again, to avoid further Nirav Modi kind of situation, SWIFT messages are linked to the CBS, the core banking system. IT-based centralized processing centers and verticals are also started. Then MSME bills discounting because of being on threads is introduced. Even the last Friday, I gave one more step further on that, linking that with the GSTN also, so that nowhere will bill discounting for the MSMEs will become a problem. So with all these linkages, they should be able to discount it with greater sense of ease. Then selection at arm's length through bank board bureau. So no selections are going to be politically interfered with. It will happen professionally. Then the MDs of banks selection from market for large PSPs and wider pool of other PSPs. So you're not limiting the choice of who can be running the bank as a managing director. From a limited pool of people, you're opening it up for the market. Whoever wishes to come to that position will now be able to give their services because they have the domain expertise. The non-executive chairman is being introduced. Earlier, only the State Bank of India had it. Now all banks shall have it. So from all this, what is the gain that we've seen, and what is it that we can put on record? We just want to show that loan recovery record levels have been reached. If in financial year 18, 77,000 odd amount was collected, 77,000 crores, now it's crossed 1,21,000 crores. That's about record recovery levels. Then the gross NPAs, I want particular attention to be drawn of the media for this. Gross NPAs have come down. So in December 2018, if you had 8.65 lakh crores, now the asset quality has improved, NPAs have come down, and the level at which they are today is only 7.90 lakh crores. The next is the provisional coverage ratio. Provisional coverage ratio. You can see in the chart which is given, the highest in the last 7 years has happened, 75.3%. This is already existing under the NPA. Complementary is provided for, right? So highest level is being provided for by 75.3%. One particular thing I'd like to draw your attention on the gross NPAs is the figures come down from 8.65 lakh crores to 7.90 crores. I make it a point to repeat this because in the recent past I had seen reports which were misleading. I hope this picture clarifies the actuals for you. Enhanced profitability, again very important. Of a total 18 public sector banks, 6 public sector banks alone had enhanced profitability when we were talking about it in the fourth quarter of year ending 19. Whereas now, when we're talking about the first quarter of the financial year ending 20, we are talking about 14 public sector banks in profit, as against 2 in the financial year of 18. So of the 18 public sector banks, 14 are in profit earning situation. I also want to report on what has happened and what has developed post the consolidation of Bank of Baroda, Vijaya Bank and Dena Bank together. So what's the impact of that? What have we gained out of it? I just want to put that before you. We've actually had wide-ranging benefits. Wider offerings and enhanced customization has happened. Operations rationalized much more than before. Verticalization initiated. Very important, just no retrenchment of any staff. Very important again, admin staffs have been redeployed for business, which means the core function of the business improves, and best practices were replicated everywhere. And when I say this, and I insist saying this, because if there was one feature which was very good in one of the 3 banks as regards human relation management, that was copied for the rest of them also. Similarly, when all of them came back together, every best practice which prevailed in this bank or that bank or the third bank were all replicated for everybody's benefit. So best practices of each bank has been absorbed for the collective gain. So that's very important there. So significantly in terms of numbers, if you want to say, the CASA growth has been robust post the merger. 6.9% has been increased, and when CASA grows, it's better for the bank because they have more liquidity and they have better credit availability for themselves. So the amount in crores is given there, 2,87,000 crores in June 2019. So this consolidation of Bank of Baroda, Vijaya Bank and Dena Bank actually has resulted in good outcomes. The next is strong retail loan growth. 20.5% increase in retail loan. Between 2018 June till June 19, there is a 20.5% growth. Today, the retail loan growth is 1,12,000 crores. And that is a significant increase from where it was earlier for the scheduled commercial banks. Moving over to the next one, the profitability has enhanced. Now, in quarter 4 of 19, year ending 19, they were in the negative of 7,113. Today, they moved positive. They are at plus 710 in the first quarter end of this financial year. So profitability has also enhanced. What has happened in terms of the potential which got unlocked? As a result of the merger, there's a very clear indication that they're poised for rapid growth and they can raise greater things in the market, and high profit trajectory can be seen whether it is loan growth, whether it is CASA growth, or whether it is in the profitability. End of the day, what is the market thinking about it? You have at least 38 market analysts who have come on to have one unanimous view that the market capitalization post this merger is expected to touch 51,000 by the time it is August 2020, from where it was 35,000 crores. So April 19 to 2020, within 1 year, that's a kind of improvement and outcome which has happened of the first merger which took place, Bank of Baroda and so on. So having done 2 rounds of consolidation, along with sustained thrust on recognition, recapitalization, resolution, process reform and so on. What is it that we want to do for the next? I've already said the target is $5 trillion economy that we want to reach, a robust banking system that we want, and for which the steps that we want to take is what we want to reveal today before you. So we are trying to build the next gen banks. So unlocking the potential through consolidation. We are going to be talking a lot about consolidation. Big banks with enhanced capacity to increase credit. Big economy, you need banks which can sustain that kind of a growth potential. And the trajectory has to be maintained from the point of view of the banking facility that we can provide for the people of India. Banks with strong national presence and global reach is what we want. Operational efficiencies, gains to reduce cost of lending. So the scaling up will only allow them to have a lot more resources, and therefore the lending costs can come down. And therefore the blueprint that we're coming up with is going to help us towards building a $5 trillion economy. Enhanced risk appetite they can have. Thrust on next-gen technology for banking. Technology is an important feature. You'll notice that further we talk about, we've given a lot of mind application for ensuring that the fintech that they operate with are all going to be such that no customer disruptions will happen and enough attention will be taken towards bank and its consolidation. Wider offerings with enhanced customization and better ability to raise resources from the market. So we very quickly give you a complete picture of what kind of consolidation we are going to be doing. The first one, before I start, the large capacity of one bank, the technology-driven capacity of another, and the strong deposit franchise the third has, are all being brought together. So Punjab National Bank, Oriental Bank of Commerce, and United Bank will be brought together, and they shall form the second largest public sector bank with business of 17.95 lakh crores, which is at least approximately 1.5 times that of Punjab National Bank. So that will be the first one that we're talking about. The second largest branch network that is available in India will be of theirs, with 11,437 branches. So the first one that we are announcing is Punjab National Bank, Oriental Bank of Commerce, and United Bank. Three together. What will this give us? A high CASA and lending capacity combined in consolidated bank. Large cost reduction potential due to network overlaps. Cost saving and income opportunities for the joint ventures and subsidiaries. Most important, the point that I said earlier, we have taken clear care that the platform that they use are compatible. In merging or in bringing together the three banks that we brought down here, we made sure that the technology which is used in this Bank 1, Bank 2 and Bank 3 are compatible, and all the three banks can enable a quick realization of gains without customer disruption, without any disruption to the service that they have to lend. We go to this most important table. The indicators that I would draw your attention to are the CET1 ratio, the CRAR, which is the capital reserve ratio, and also to the net NPA ratio, the three above the category of employees, which is very important for you to notice. And all the three are very critical indicators to tell you that this consolidation in this particular case is absolutely healthy. And we've kept all the Basel norms, RBI's guidelines and the Basel norms in mind, even as we have put these numbers together for you. If you have any questions, we'll be able to answer it later. I don't want to labor on each one of them, but I want to completely give you the confidence that we've applied our mind on the Reserve Bank of India guidelines and also on the Basel norms, which will have to tell us what these numbers ideally. I can go further to explain.